Welcome back to the Deep Dive. Today, we are taking a granular forensic look at a comprehensive investment memo focused on a company that has, well, quietly become a dominant force in one of the world's most dynamic consumer markets. We are dissecting the case for Atour Lifestyle Holdings Limited, which trades on the NASDAQ under the ticker ATAT.
And this is a fascinating target because Atour isn't just another hotel chain. They are China's leading upper mid-scale lifestyle hotel chain.
Right.
We're talking nearly 2,000 hotels across 219 cities as of the third quarter of 2025.
Yeah.
But the core of our deep dive today is really understanding why their scale has translated into such exceptional financial performance.
That scale is certainly impressive, but as our sources stress, the operational scale is, only half the story.
Exactly.
The truly unique element here, the structural differentiation that makes this company stand out, is its pioneering hybrid model, which couples the asset-light hotel structure with something they call scenario-based retail.
Precisely. They pioneered this idea of selling private label goods. The bedding, the toiletries, the specific items you use and love during your stay directly in the hotel.
And this isn't some small gift shop afterthought.
No, not at all. This retail segment contributes a substantial chunk of their business, currently accounting for about 1/3 of their total revenue.
1/3 of revenue from retail for a hospitality company is, that's just unheard of in traditional models.
It really is.
So our mission today is to unpack the entire thesis. Does this differentiated hybrid model create a durable competitive moat? And is the company, backed by what appears to be high-quality management, capable of sustaining its aggressive growth?
The numbers certainly suggest momentum.
Oh, yeah. Revenue surged 55% in 2024 and was up another 38% year-over-year in Q3 2025.
The executive summary is certainly bullish. This model has demonstrably driven rapid, profitable growth, often significantly outpacing larger, more traditional peers.
But the critical question for long-term investors, and for you, the learner, trying to determine if this is a high-quality long-term compounder, is durability.
Right. It can't last.
Exactly. Is the foundation built on brand loyalty and this manichized model strong enough to sustain this aggressive double-digit expansion for the next 5, maybe 10 years?
Yeah, that's the key. We really need to look closely at their history and their financial architecture to find that answer.
Okay, let's unpack that historical journey then. Atour wasn't born out of blind luck. It seems like it was a deliberate response to a market opportunity identified by someone who knew the industry inside and out.
That's right.
The story begins in 2013 with founder Haijun Wang.
Wang had the perfect vantage point. He was the former executive VP at Huazhu, which is China's largest hotel group. So, he spent years watching the mechanics of this massive, fragmented Chinese hotel market.
So he saw it all from the inside.
He did. And what he observed was a crucial structural flaw. The market was heavily dichotomized. On one side, you had this vast network of low-cost budget accommodations. And on the other, you had the high-end luxury hotels.
So the gap was squarely in the middle.
Exactly. He spotted the underserved niche for the upper mid-scale segment. And this wasn't just about a pricing opportunity, it was a cultural one.
What do you mean by that?
Well, China's emerging middle class was experiencing this rapid economic ascent, and they were actively trading up their consumption habits. They had the disposable income to demand quality, design, and reliable service.
But they didn't want or need the expense of a 5-star resort for, say, a business trip or a short stay.
Exactly. That's a powerful demographic tailwind to have at your back.
So how did Atour immediately position itself to capture those aspirational travelers?
From day one, Atour focused on being a lifestyle brand, not a commodity room provider.
Okay, so differentiation through experience.
Right. That meant premium, minimalist decor, high-quality, curated amenities, things like specific bedding, proprietary bath products, and, importantly, they invested heavily in social spaces.
The lobbies?
Yeah, they pioneered the idea of the hotel lobby being a genuine community hub with shared working spaces, reading nooks, and even well-stocked libraries. They turned the functional aspect of staying overnight into a cultural experience.
So they weren't selling utility, they were selling aspiration and comfort.
That's a great way to put it. And that kind of foresight allowed for really rapid scaling through the 2010s.
And it worked.
It did. The market validated their concept quickly, and Atour became the largest upper mid-scale hotel chain in the country by room count by the end of the decade. But the real visionary moment, the strategic inflection point that structurally separated them from every peer, was that retail pivot around 2016.
This is the scenario-based retail. We need to understand the mechanism here because this seems to be the core of their moat. How did they convince customers to start buying the hotel property?
They leverage that initial focus on premium experience. If you provide a truly premium pillow or a distinctive high-quality shampoo, the guest naturally develops a strong affinity for that product during their stay.
Sure, you think, wow, I slept so well, or this smells amazing.
Exactly. Atour simply converted the hotel room into the ultimate non-pressurized showroom. They started selling private label versions of the in-room items, bedding, fragrance, bath products, and they opened small Atour Market retail outlets right there in the hotels.
That seems brilliantly efficient. Instead of paying for advertising or store leases, their customer acquisition cost for retail is simply the operating cost of the hotel room.
That's precisely the mechanic. And the
Mhm.
financial response was dramatic. We see in the sources that the retail gross merchandise value, the GMV, grew at an astronomical 140% compound annual growth rate between 2016 and 2020.
140%.
Yeah. And while that started from a low base, it transformed Atour from just a hotel operator with a nice brand into a true travel lifestyle platform. By Q3 2025, that revenue pillar stabilized, providing around 32% of total revenue.
An enormous high-margin ancillary stream that competitors still struggle to replicate.
For sure. And that dual-engine hospitality plus high-margin retail,
Mm.
it became a lifeline during the most significant modern challenge, the COVID-19 domestic travel crisis in 2020.
Right, so how did that foundational loyalty protect them?
The foundation was the A-Card loyalty membership program. By 2021, they had already accumulated over 25 million members.
Wow.
Critically, during the crisis, this loyal domestic demand pool sustained the business because they relied less on broader, often volatile market forces.
And the high repurchase rate of those members must have been a key metric for resilience.
It was the ultimate stabilizer. The data shows a member repurchase rate of nearly 49%, meaning half the people who stayed once in a year would book again that same year.
That's incredibly sticky.
In a crisis where overall travel volumes plummeted,
Hmm.
having half your customers return quickly proved invaluable.
And that loyal direct channel gave them immense control over their distribution costs, I'd imagine.
Absolutely essential. Because those members book directly through the A-Card app or their WeChat mini program, Atour's reliance on costly online travel agencies, or OTAs, dropped to less than 20% of room nights in 2020.
Which saves them a fortune in commissions.
A huge fortune. This high direct booking rate provided both immediate resilience and operational agility, allowing them to manage pricing and communication directly, avoiding the heavy 10 to 15% commissions that burdened their OTA-reliant peers.
Beyond operations, management showed remarkable regulatory savvy in their journey to list in the U.S. They filed for the IPO in mid-2021, which was right before the Didi fallout instigated a major regulatory freeze on Chinese overseas listings.
Bad timing.
Horrible timing, but they chose to pause rather than rush.
That decision was a masterstroke of patience and prudence. Instead of fighting the headwinds, they used the year-plus delay to restructure corporate entities, ensure regulatory compliance, and, crucially, to align strategic investors.
Right, this is where Trip.com came in.
Exactly. This brought in significant endorsements, notably from Trip.com Group China's largest OTA, which acquired a large stake, aligning their massive distribution interests directly with Atour's success. Legend Capital also deepened its involvement.
So they turned a potential crisis, a regulatory freeze, into an opportunity to strengthen their institutional backing.
They did. And that patience ultimately paid off for their November 2022 NASDAQ debut.
Which went well, as I recall.
Very well. They executed the IPO in a very challenging market climate, pricing conservatively but seeing a 41% pop on day one. That just validated management's credibility and timing.
And it gave them capital to expand.
It did. Given their asset-light structure, they didn't need to raise a huge amount, but the successful debut provided the dry powder to accelerate expansion immediately as travel rebounded. They opened a record 152 hotels in 2024, just demonstrating their ability to execute rapid, controlled scaling.
So, as Atour transitioned into the modern era, they carried forward two massive legacy advantages: a deep customer loyalty bank exceeding 25 million members, and a battle-tested, asset-light franchise model ready for acceleration.
Yes, but the tension now shifts to a new challenge: managing the dual mandate of being a high-growth company while also adopting the characteristics of a mature capital-returning entity,
The dividend.
the dividend. Starting in 2023 and escalating in 2024, management made the strategic decision to initiate a formal dividend policy, committing to return at least 50% of the prior year's earnings to shareholders.
What does management gain by making that signal so early in their growth curve? Why commit to returning cash when they still have such a vast addressable market?
It's a very sophisticated strategic signal. It implies two things.
Okay.
First, immense confidence in the future cash flow generation of the asset-light model. They believe they can fund aggressive 27% year-over-year property count growth and still have surplus cash.
And the second.
Second, it signals disciplined capital allocation. They are actively avoiding value-destructive M&A or just hoarding cash on the balance sheet. This dual mandate growth and returning cash not only attracts traditional growth investors, but also income-focused investors, which broadens their appeal significantly.
So the historical foundation is robust, but the scrutiny now shifts to how effectively they manage this crucial tension between reinvestment and returns.
That's the challenge ahead.
Let's transition now to the financial architecture that supports these aggressive returns. The core engine is this asset-light model defined by the Manikai's structure. We need to define exactly how this business structure works in practice.
Okay, so Atour's business is fundamentally split into hotel operations and retail. Within hotel operations, the magic happens in the split between the Manikai's hotels.
Which is a portmanteau for managed and franchised, right?
Exactly, managed plus franchised, and the few leased properties they still operate.
And the goal, clearly, is to shift all capital risk onto third parties.
Absolutely. The Manikai's model is paramount. Of their almost 2,000 properties, nearly 1,900 are Manikai'd.
Wow, almost all of them.
Yeah. This means a third-party owner, often a local real estate developer or investment group, bears the massive capital expenditure required to buy, build, or convert the physical hotel asset. Atour doesn't use its balance sheet for real estate.
So if the franchisee provides the capital, what does Atour provide and how do they get paid?
Atour provides the high-value intangibles, the brand, the proprietary management systems, the standardized operating procedures, the supply chain, and most critically, access to that 25 million plus A-card loyalty network.
And in return, they collect fees.
High margin fees, yes. These typically break down into three types: an initial franchise fee, ongoing royalty fees, usually a percentage of gross room revenue, and then performance-based management fees.
And this structure creates vastly superior economics compared to owning the real estate.
The revenue split confirms this. In Q3 2025, approximately 59% of their total revenue derived from those high-margin Manikai's fees.
59%.
And only about 6% came from the remaining 24 self-operated leased hotels, which carry high operating costs and capital risk. But offloading capital intensity, Atour achieves margins and, crucially, an exceptional return on invested capital, or ROIC, that traditional asset-heavy hotel chains just cannot match.
So the franchise system is really the financial engine. It generates software-like margins.
That's the perfect analogy.
Okay, so moving to scale, Atour operates exclusively in China, but how big is the pie they are currently slicing?
Well, China's travel market is enormous, but Atour dominates its specific high-growth niche. They are the clear leader in the upper mid-scale lifestyle segment, holding an estimated 10 to 15% market share by rooms.
And they're expanding into new areas.
They are. While they cover 219 cities, recent expansion is shrewdly focused on higher growth, lower tier cities where the quality supply gap that Void Wang identified back in 2013 is still immense.
For the listener trying to grasp the scale, what does the projected growth runway look like? How much penetration is left?
The opportunity remains staggering. Management guidance explicitly states they see potential for at least 3,500 hotels domestically.
Okay, and they're under 2,000 today.
Right. So that means Atour has only penetrated about 50% of the possible locations they've identified, and conservatively, maybe 20 to 25% of the overall serviceable market in China.
So there's a clear growth trajectory for years to come.
For sure. It's capable of sustaining double-digit expansion for the next 5 to 7 years, purely through domestic organic growth.
We see that massive runway reflected in their growth rates. At 38% YoY Q3 2025 growth, they are significantly outperforming established large peers.
They are actively taking market share. For instance, Huazhu's upper mid-scale segment grew around 15% in 2024. Atour's growth rate is more than double that.
So what does that gap indicate?
It indicates they are winning share from both smaller, unbranded, independent hotels, which lack the loyalty network, and the slower-moving legacy chains that haven't adapted to the lifestyle trend.
This brings us to the core question: moat durability. If the retail pivot is so successful, why aren't larger competitors like Huazhu or Marriott immediately allocating massive capital to replicate it? What prevents a fast follower from just copying the model?
It comes down to the reinforcing cycle, which takes years to build and is not purely transactional.
Yep.
Atour's moat is built on two things: brand affinity and cost structure. Brand affinity is derived from the unique, reliable quality, the premium bedding, the curated amenities that really resonates with the younger, aspirational Chinese traveler.
And how does that brand affinity translate into a defensive business structure?
It creates a powerful, self-sustaining loop. The lifestyle experience attracts guests who become A-card members and buy the high-margin retail products.
Right.
This loyalty allows Atour to maintain a high RevPAR premium revenue per available room compared to competitors. That high, stable RevPAR is the single most attractive metric for a franchisee.
Because it proves profitability.
It proves profitability. Therefore, that superior profitability attracts more franchisees. This deepens the network, making the A-card program even more valuable, which in turn attracts more guests.
So the brand creates the retail, and the retail creates the loyalty, which creates the franchise demand. It's a beautifully closed loop.
It is.
And this locks in the franchisees too, right?
Absolutely. The switching costs for a franchisee are enormous. If they leave the Atour system, they lose immediate access to over 25 million active, loyal members. That customer base is the lifeblood of their occupancy and revenue.
So the brand is sticky on the B2B side as well as the B2C side.
Exactly. And we also noted the huge cost advantage derived from this loyalty.
The OTA fees, or lack thereof.
Right. This is material, enduring financial advantage. With over 80% of bookings coming through proprietary direct channels, Atour avoids paying the hefty 10 to 15% commission fees charged by OTAs.
Which is like a structural cost advantage.
It is. Think of that as a structural 10 to 15% lower cost base compared to peers who rely heavily on third-party distribution. Atour can reinvest that savings into enhancing the brand experience, offering better rewards to members, or simply dropping it straight to the bottom line for shareholders.
So that direct channel isn't just convenient, it's a foundational competitive cost advantage.
Absolutely.
Let's dedicate some serious time to the A-card program because we've established it as the operational and financial bedrock of the entire enterprise. It dictates the distribution channel and it fuels that retail engine.
The effectiveness of the loyalty program is truly the most remarkable element of this model. Over 80% of bookings are direct, funneled through the A-card app or the WeChat mini program.
And it's more than just a booking portal.
So much more. It's a proprietary data engine. They collect granular data on everything: preferences, retail purchases, frequency, location, which allows for highly efficient, targeted marketing.
The retention metrics you shared earlier are fantastic, especially for a fragmented sector, an almost 49% repurchase rate in the same year.
It's incredible.
That speaks to a deep ingrained customer habit.
It does. It shows that once Atour enters a customer's travel consideration set, it becomes the default option. They have successfully established trust and reliability.
And the customer profile seems to be a real asset.
For sure. It provides excellent demographic tailwinds. Over 70% of their customers are under 40 years old. They are capturing the digitally native, trend-setting, and increasingly affluent segment of Chinese travelers.
So the loyalty is generational.
You could say that. It ensures the customer base will continue to mature and grow its spending power with the company.
And this sticky customer base translates directly into go-to-market GTM efficiency. If your customers are already in your ecosystem, your customer acquisition cost, or CAC, must be inherently low.
Absolutely. The A-card network acts as a built-in demand generator, drastically minimizing the need for expensive, broad-based marketing campaigns.
But they still spend on marketing.
They do. Their marketing expense was around 13.5% of revenue in Q3 2025. But that spend is highly efficient because it's not being siphoned off by OTA commissions. Every dollar of marketing builds equity and drives direct conversion within the Atour ecosystem.
This efficiency also clearly extends to the B2B side franchise acquisition. A pipeline of 754 hotels under development is a massive endorsement from prospective owners.
That pipeline is a crucial metric demonstrating successful B2B GTM. Franchisees are not speculating. They are making calculated capital allocation decisions.
And what attracts them?
They're attracted by two things: the high RevPAR premium Atour delivers, and the highly stable, high occupancy rate, which consistently sits around 80%.
And that's above average.
Significantly above the industry average. It establishes Atour as the profitable, reliable choice for owners in the upper mid-scale space. They see Atour as an immediate solution to fill rooms profitably.
Let's get back to monetizing that loyalty. The retail engine. We know it contributes a third of revenue, but what are the unit economics of selling those private label goods?
The profitability is exceptional. Retail products boast a gross margin of 52 to 53% in Q3 2025.
52%? Wow. How do they achieve that?
This margin structure is crucial, and it's achieved because of two distinct competitive advantages. First, private labeling. Atour designs, sources, and manufactures its own goods, allowing them to capture the inherent manufacturing margin that a traditional hotel selling third-party brands would forfeit.
And the second advantage?
Leveraging the existing infrastructure.
Right.
They use the hotel room itself, the inventory, the staff, the lobby market as the sales and distribution platform, minimizing incremental sales costs. They don't have to build a separate retail chain.
They just use what they already have.
Exactly.
So how dramatically does this high margin upsell component affect the lifetime value, or LTV, of a customer?
It provides a substantial and quantifiable LTV enhancement. We estimate it to be between 10 to 20%.
Can you put that in context?
Sure. To put it in perspective, the average retail spend per room night was estimated at approximately RMB 144 in 2024. That is substantial incremental revenue generated from existing infrastructure and existing customers' revenue that their traditional competitors simply miss entirely.
So we have very low CAC, high repeat rates, which means a high LTV, and a high margin upsell component. You mentioned earlier that the LTV CAC ratio is likely exceptional. We need to justify that claim of potentially exceeding 30x.
Let's walk through the math conceptually. If their CAC is structurally lower due to direct booking, say 10–15% lower than peers,
Okay.
and they manage to retain nearly 50% of customers within the same year,
Right.
and they then boost the LTV of those customers by another 15–20% through high-margin retail sales, the multiplier effect becomes massive.
So a ratio of 30x means every dollar spent to attract a loyal retail buying member generates $30 in total lifetime value.
That's it. This demonstrates that Atour is not just growing. They are growing with extraordinary economic efficiency. They're acting as a self-funding growth machine.
That economic proposition clearly resonates with the B2B partners, given the metric on franchise stickiness.
The metric is stark, and it speaks volumes about sustained value. Essentially zero voluntary franchise churn.
Zero.
No reported hotel has left the Atour system to join a rival chain or go independent. If franchisees were struggling, they would be leaving. The fact that they are staying proves that the superior economics Atour promises high RevPAR and high occupancy derived from the A-card network are being delivered consistently.
Let's consider future optimization. With Trip.com as a major strategic shareholder, what's the potential for future GTM evolution?
The strategic alignment with Trip.com, a massive distribution partner, provides incredible optionality that is yet to be fully realized. It's entirely logical to assume they will deepen integration.
What would that look like?
It could mean co-branded programs, exclusive bundle offerings, or seamless points transfers, effectively channeling Trip.com's enormous user base directly into the Atour ecosystem.
Which strengthens the direct channel even further.
Exactly. Reducing any residual reliance on other third parties and driving even greater efficiency in the loyalty loop.
This unique combination of an asset-light model and high-margin retail should naturally lead to superior financial metrics. Let's look at the hard numbers confirming Atour's financial quality.
The returns on capital are exceptional, especially considering they operate without meaningful leverage. When we look at return on equity, or ROE, it was approximately 35% in 2024.
35%.
But the more telling metric for this business model is return on invested capital, or ROIC. Because they use so little of their own capital for expansion, shifting the burden onto franchisees, their ROIC is estimated to be in the 30 to 40% range for 2024.
To put that in context for our listeners, those are figures you usually see in mature, highly efficient technology or intellectual property businesses, not necessarily in the capital-intensive hotel sector.
No, it's very rare. It proves the Manikai's model is truly paying off. It highlights the power of the high-margin fee structure.
And we see operating leverage clearly reflected in their margin trend.
We do. Net margin has consistently improved, moving from 12–13% in 2022 up to a robust 17.6% in 2024. Their EBITDA margin is equally robust, steady in the 27–28% range.
And what does that demonstrate?
It demonstrates that their corporate and technology costs are growing much slower than their revenue, meaning each new Manikai's hotel they onboard drops a disproportionately large amount of incremental profit to the bottom line.
There is also a major green flag related to the quality of those earnings, which is often crucial in high-growth companies.
Yes, the quality of cash flow is superb. The sources highlight that their operating cash flow consistently exceeds their net income.
And for the learner, why is that important?
It's a sign of high earnings quality and strong cash conversion. Why? because they operate on a negative working capital cycle. Customers pay upfront for rooms, and franchisees pay fees regularly. Atour is collecting cash before the costs associated with generating that revenue are due.
So minimal receivables and a huge, healthy inflow of cash. Furthermore, that cash generation hasn't led to a risky balance sheet. Their leverage is minimal, providing tremendous safety.
The balance sheet is extremely conservative. As of Q3 2025, Atour was essentially in a net cash position. They held RMB 2.7 billion, or roughly $375 million in cash and equivalents, versus a negligible RMB 67 million in total debt.
So plenty of cushion.
Significant financial cushion, allowing them to withstand major macroeconomic shocks and fund expansion without needing external expensive financing.
Now we arrive at valuation. A 20x forward PE sounds a bit steep. How do we justify that this high-quality, growth-driven company is still a reasonable investment at its current price?
This is where we have to apply the growth at a reasonable price, or JRP framework, to contextualize that PE multiple.
So we look at the PEG ratio PE divided by the growth rate. Let's make sure we clearly define that for everyone.
The PEG ratio measures how much you're paying for each unit of growth. A high PE is justified if the growth rate is equally high or higher. Atour trades at 20x forward PE, but its earnings growth is projected to be in the 35% range for 2025.
So that gives you a PEG of, what, 0.6?
Roughly 0.6, and a PEG ratio under 1 is universally considered attractive for a high-quality growth company.
And how does that compare to the slower, established hotel industry?
If we look at traditional global giants like Marriott, they trade around 18x forward earnings, which is similar to Atour's PE, but their growth rates are typically in the mid-single digits, maybe 5% to 7%.
So their PEG is much higher.
Much higher, closer to 2x or 3x. Atour is trading at a similar multiple, but generating multiple times the profitable growth and superior ROIC. The premium valuation is entirely justified by the speed, quality, and capital efficiency of the growth they're generating.
So the financial trajectory remains positive, the unit economics are robust, and likely to improve further.
They should. As the loyalty base deepens, the marketing and customer acquisition costs should continue to decline relative to the massive revenue base, which further boosts margins. The upside is clear: sustained 30% plus earnings growth.
And the downside.
The downside risk is substantially mitigated by that high ROE, the net cash balance, and the formalized dividend policy, which provides a yield floor for the stock in case growth temporarily slows.
Financial execution is a reflection of leadership. Let's assess management quality under founder Haijun Wang, particularly regarding capital allocation and shareholder alignment.
The most important signal regarding management's confidence and discipline was the implementation of the dividend policy in 2024.
Right?
Committing to returning at least 50% of the prior year's earnings, paying out $108 million in 2025, is not a trivial decision for a company still in rapid acceleration mode.
So why is this considered disciplined capital allocation?
Because it places a hard constraint on management, it forces them to be highly selective in M&A opportunities, and ensures they are not building up excess cash for non-productive uses.
So it's a signal to the market.
It's a signal that the asset-light model is so efficient at converting growth into cash that they don't need 100% of earnings for reinvestment. This proactive commitment attracts and retains shareholders who value stability and consistent returns alongside growth.
And their operational execution, maintaining quality while scaling so aggressively, also speaks volumes about their management systems.
Absolutely. The management team has proven its ability to standardize and scale. They grew the property count by 27% year over year in 2024.
A huge number.
Yet operational control remained tight, evidenced by occupancy holding steady at approximately 80%. This shows they have successfully scaled their training, supply chain, and standardized systems to absorb massive growth without diluting the premium brand quality.
Which is critical for maintaining franchise satisfaction and the Rev PE premium.
It's everything.
Let's address the leadership structure itself. The business is founder-led by Haijun Wang. While this often drives vision, it sometimes creates governance risks.
That's a fair assessment. Atour certainly benefits from stable, consistent, founder-led leadership. Wang retains a large equity stake, roughly 19–22%, which aligns his personal wealth directly with long-term shareholder returns.
But there's a dual-class share structure.
There is, and we have to note the structural risk there. Wang holds about 70% of the total voting power. This concentrates decision-making heavily in his hands.
How should listeners assess and mitigate that structural risk?
Well, the risk is mitigated by strong alignment and external oversight. First, the large equity stake means Wang has skin in the game.
Okay.
Second, the board includes representatives from highly sophisticated institutional shareholders, specifically Trip.com and Legend Capital. These external voices ensure that major strategic and financial decisions are thoroughly vetted.
And from a forensic perspective.
From a forensic perspective, Atour maintains a clean audit history with PwC, reporting no material weaknesses in internal controls, which provides significant confidence in the underlying financial integrity.
Shifting to external risks, since Atour operates 100% in China, the macroeconomic environment and geopolitical risks must be considered primary threats.
The primary risk, hands down, remains macro, China's economic cycles. A sustained, severe downturn could pressure discretionary travel, impacting RevPAR and occupancy.
But they've weathered storms before.
They have. Their proven resilience during the 2020 domestic crisis, where they leaned successfully on their loyalty base, suggests a strong operational buffer. And their net cash position provides an immense financial cushion to weather those external shocks.
And the geopolitical and regulatory risks associated with being a Chinese ADR, specifically the HFCAA, the Holding Foreign Companies Accountable Act, is always a concern for U.S. investors.
That risk, while perpetual, has been significantly mitigated in the near term. The 2022 agreement allowed the PCAOB, the Public Company Accounting Oversight Board, access to inspect audits of Chinese companies.
So the delisting risk has receded.
For now, yes. Atour has not been identified for near-term delisting risk. And crucially, the business is 100% domestically focused. The underlying business risk is relatively low. The risk is primarily structural, related to the U.S. listing mechanism.
What's a potential mitigation for that?
A potential mitigation, though it's unannounced, could be a secondary listing in Hong Kong to provide an alternative trading venue should U.S. regulatory pressure increase again. The risk is manageable, especially given the operational strength of the underlying asset.
Finally, what about the long-term risk associated with the founder centrality?
Founder centricity is an acknowledged long-term risk. Success in a company so driven by strategic vision is often tied closely to the visionary. However, this risk is mitigated by Wang's active involvement and the stability he provides, along with the recent professionalization of the supporting management team, like having specialized co-CFOs managing finance and capital markets. Given their strong track record of prudence and controlled, aggressive scaling, the management quality appears high enough to continue gaining market share, regardless of external macro headwinds.
We started this deep dive evaluating a comprehensive investment thesis, and I think we found compelling evidence of strategic foresight, superior unit economics, and high-quality execution that extends from the brand identity all the way through to capital allocation decisions.
To synthesize this highly differentiated story, I think we have 4 core takeaways that solidify Atour's standing as a high-quality compounder.
Okay, let's hear them.
First, they possess a truly durable moat. Atour doesn't just operate hotels, they command a unique, defensible position in the high-growth, upper-mid-scale segment, cemented by the seamless integration of their lifestyle brand and that sticky A-card loyalty program.
Which makes their offering fundamentally difficult to substitute or copy.
Exactly. Second, the company exhibits exceptional financial quality. The asset-light Manicized model drives industry-leading returns on capital with ROE and ROIC exceeding 30% and generates robust free cash flow.
Right, the cash flow consistently exceeding net income.
Which ensures profitability is the engine of growth. Third, management has demonstrated crucial capital discipline. The formal decision to initiate a significant dividend policy signals profound confidence in the sustainability of future cash flows and strong alignment with shareholder interests.
Positioning Atour as a rare and attractive growth plus yield play in the consumer space.
Absolutely. And finally, the growth runway remains extensive and domestically funded. With only 20 to 25% of the domestic serviceable market penetrated and a robust pipeline of over 750 signed agreements, the high-growth expansion trajectory is clearly defined and largely funded for the next 3 to 5 years.
Assuring sustained double-digit revenue expansion.
For sure.
Atour has built a machine that effectively converts a premium brand affinity and guest loyalty into high-margin revenue through its retail segment, a segment that most competitors overlook entirely. The current valuation relies entirely on continued domestic market capture. But the question we leave you with, the learner, is this. What is the true, unpriced growth optionality in their future? Can the proven Atour lifestyle successfully resonate beyond China, perhaps serving the massive wave of outbound Chinese tourists in popular overseas destinations like Southeast Asia or Japan? If they can export the Manikai's retail hybrid model successfully, they could create an entirely new, massive growth engine that the market hasn't even begun to price in yet. That's the trajectory to mull over until our next deep dive.